So this is going to be a very helpful video going over in detail the best expiration contracts that you guys should choose when you're trading options. Now, I've made a video in the past about choosing the right strike price, since in my opinion, you need to fully understand strike prices and expirations in order to trade options successfully. I'll link that video below, and I'm also going to link my Instagram below. So if you aren't following it, make sure you do, because I post daily trade recaps on there. I post some good tools and tips and pictures that every trader, I think, in my opinion, should be aware of. So without further ado, let's get into the first point I want to make about choosing the right expiration contracts. And that is, you have to understand what type of trade that you're looking to put on before you enter the trade itself. You know, every trade that I put on is predetermined. It's planned out before I actually buy or before I actually sell. My entries are planned out, my exits are planned out, my stop losses are planned out well before I enter that trade. Now, in order for you to do this, and because you do this, you're not going to be susceptible to the normal human cognitive flaws that every trader and every human naturally has. Greed and fear and certain psychological emotions that are going to affect your trading abilities. So you have to predetermine, you have to know your exact points before you put that trade on. That is a key point right there. Now, because you do this, you're going to know exactly where you're going to take profit if you're right. You're going to know exactly where your stop loss is going to, if you're going to be, your stop loss is going to be if you're wrong, and you're going to know exactly where you're going to enter when your signal hits. So when you do this, you're going to be able to understand what type of trade that you're looking to put on. Just like strike prices, and in that video that I made, you have to know what type of trade that you're looking to put on before you enter your contracts, and before you determine your expiration, and before you determine your strike price. So, like I said, if you're a day trader, then one expiration is going to be better than the other, versus someone that's swing trading and looking to hold for maybe a week, 2 weeks, a month. Their expirations are going to be different than someone who is scalping or day trading, because obviously you need to buy more time. So the first example I want to show is SPY. So I've seen people who were right on the underlying stock. Now I'm going to explain this example later on once we get to later on in the day. But I've seen people and I've seen traders who take trades that would have been great trades. You know, they bought, let's say, in an area at the bottom, and the stock was moving up. You know, the underlying stock was going in their favor. But because they bought the wrong expiration contracts and the wrong strike price contracts, they actually, in fact, lost on that trade because they did not buy the proper expiration or strike contracts. You know, you can be right on the underlying stock and still be wrong if you choose the option contracts that are not best suitable for your trade. There's a thing called theta with trading option contracts, and basically theta is your worst enemy if you're trading contracts that expire soon. So theta measures the daily rate of price decline in the options premium as it gets closer to its expiration date. So in this case, we're looking at SPY. So SPY expires every Monday, every Wednesday, and every Friday. Normal stocks will expire every Friday. But in this case, we're trading SPY, and SPY expires 3 times a week, where a normal stock will only expire once a week for that current week expiration. So in this example, I'm going to show you if we bought calls at this 30-minute demand on SPY, and let's say we had a target at this 287.50 area, which was some type of supply. I don't know exactly what time frame, but like I said, we're buying a bounce at this demand. Our stop loss is below this low a day, and our take profit target is at 287.50 area, which is supply. So I'm going to go in here and I'm just going to buy, let's say, the 288 contracts for this week's expiration, or for today's expiration. In this case, it is a Wednesday. So these contracts expire today. They have 0 DTE, which is basically days to expiration. And you could see that by these numbers right here as we go down the columns, which shows you the days until expiration. So the 288 strike calls that I'm choosing right now are expiring today. And what that means is that as the stock moves up or down and it does not get closer to in the money, as the day moves on, these contracts are going to slowly decrease in price until they're at zero, because if we are not in the money by the time of expiration, they are worthless. They are worth nothing. They're worth zero. So if I show you this on the right side, is that 288 for the current day's expiration. It is basically a chart that as time is going on, if the stock is not moving up or the stock is moving sideways, these premiums are basically going to go to zero. As you can see here, the stock moved up, the stock was kind of sideways, but the premiums were basically at zero. They were worthless because of the fact that we were buying the 288 strikes for the current day's expiration. So SPY would have had to got up to where my cursor's at, right up here, for these contracts to be in the money. And the percentage chance of that happening is very slim. That's why these are worthless, because as time gets closer to expiration, Theta will burn and Theta will kill your option contracts. So it's important to understand that you have to know what type of trade you're looking to enter at. Let's say we were buying, I don't know, a low a day break on, or let's call it a high a day break on SPY. We bought above the high a day. We're looking to make maybe 20, 30 cents, 50 cents on the stock and make a couple of cents on the contracts. That is acceptable if you're playing 0 days to expiration, because your trade is fast. Your entries are fast, your exits are fast. You're basically scalping the stock. Therefore, you're not looking to hold on to it for anything longer than 10 minutes, 5 minutes. So scalping with 0 days to expiration is going to really benefit you guys, because that's when you're going to be able to get high percent returns. That's when you're going to see the contracts going up 1,000%, etc. in a single day. So 0 days to expiration are also going to be cheaper, and they will give you guys higher percent returns. They're going to yield greater returns than, let's say, contracts that have time. So let's say we bought SPY at the demand down here, and sold. Let's in hindsight, let's say we sold it at high a day. So from a low to a high, this was a 251% return. That's why it's acceptable if you're scalping a trade really fast. It's okay to play 0 days to expiration. But let's say we're day trading this and we're sticking to our plan. We have a target at the supply, entry at demand, stop loss at low a day. If we're day trading this and let's say, we're buying the 288s because we have a 288 area target. What I want you guys to understand is that if you were to put a stop on this trade and you stuck to the plan, the stock came up here, you didn't take profit because it never hit your take profit area. And now you're still in this and you're holding on, you're kind of bag holding it. You're kind of holding it until low a day and you plan on stopping out, right? So this is where our entry was on the contracts if we bought at demand, which was in this 19 cents area. And it went from 19 to about 76 cents, which is a good return. But if we held until basically low a day broke, we would have got stopped out at about 7 cents compared to where our entry was, which was at 20 cents about. So right then and there, these contracts do not match up exactly to what the stock looks like. If you buy contracts that are further out in expiration, these two charts are going to look somewhat identical. This low right here at 19 cents isn't the same as the low as it is over here, which is at 5 cents or 6 cents. So if you were to buy contracts with more time and you got stopped out, let's buy the same contracts. These contracts that now have 7 days to expiration, if you were to get stopped out, let me remove this. If you were to get stopped out, you would get stopped out, your entries here at 275, you would get stopped out about 272. So that's about exactly where you got in at, compared to the current week's expiration where you would have got stopped out at way lower because of the fact of A, the contracts are moving down and we bought call contracts. So right then and there, the underlying is not moving in our favor. And B, we are way below where our strike price is at compared to the expiration date. And the chances of the stock moving up close to in the money and those contracts becoming some value is pretty slim. That's why we're losing value very fast on the current week's expiration. Okay, so now I want to illustrate this point to you, showing you how Theta will burn your contracts if you trade 0 days to expiration, and as it's moving later on in the day, getting closer to expiration, and we're not going anywhere near the money. This also includes contracts that are later in the week, not necessarily at expiration, but showing you how sideways action will completely burn your contracts. So right here we have SPY. We have our first bounce. I labeled 1, second at 2, third at 3, which lines up exactly with the 0 day to expiration 283 strike calls. Loaded it up on the right. So on the right screen, we have our option contracts like always. Let's say we bought at circle number 1, where SPY was coming into 4-hour demand and then started producing a little bit of a bounce. At that time, the contracts we could have got at, let's say 25 cents, and went to a high of about 57 cents, which is about 130% return. Not bad for maybe 30 minutes. Now, if we were in the contracts here and let's say did not take profit where I just illustrated, we did not take profit at this high, and we held the contracts because we thought we were going to go for a late afternoon rally. If the stock then dipped down like it did, illustrated in point number 2, our contracts are pretty much at break even on the right side compared to where the stock is, where it's still above our entry point. Now, fast forward to number 3, which we did not even break our low yet of number 1. But on the option contracts, we are way below the low. So this is from 0.25 to 0.15, which is about a 43% loss, even though the stock did not go below that low. And even though we're still right on the direction, because of the stock is pretty much sideways. So stock is sideways, but look at these contracts as they completely go down in value, even though the stock is completely sideways. That is Theta Burn. The closer you get to expiration, the faster your contracts are going to burn if they do not get closer to in the money by the time of expiration. So I have 2 rules. What I do is if I'm scalping, I'll play 0 days to expiration if we're not close to 4 o'clock Eastern when the market does close. Second rule is that I do not play 0 days to expiration as a day trade, holding for maybe an hour, 2 hours, 3 hours. I have a target way above, way below. I do not play 0 days to expiration from Wednesday, Thursday, and Friday. So Monday and Tuesday, it's okay to play the current week's expiration, but Wednesday, Thursday, Friday, stay away from the current week's expiration, because if you are wrong on the direction, or even if you're right and the closer we do get to expiration and the stock is not moving in your favor, your contracts are going to burn fast, like this example I just showed you.